welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Square Communications. Each episode, we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Emma Cameron, partner and head of investment consultancy at Hymans Robertson. Welcome to the show, Emma.
Great to be here. Thanks, Charlotte.
Lovely to have you. Do tell us, what is your news story of the week?
My news story of the week is from Professional Pensions and was published on the 8th of May. The headline is DB funding position remains stable in April amid market volatility, finds Broadstone.
Yeah, it's a good news story. Tell us, what was it about that story that caught your eye? Why did you make it your news story of the week?
April was a volatile month within investment markets, yet DB scheme funding levels were largely immune to the volatility. Improved funding positions over recent years have led to de-risked investment strategies with higher levels of interest rate and inflation hedging. Many schemes are moving to be fully funded on a low-risk basis and beginning to see surpluses emerge. In aggregate, schemes are in a much better position and more resilient than they were a few years ago. And I think this story just highlighted that.
Yes, and given all of the market gyrations we had with Trump's tariff tantrum, it is a remarkable case that, that scheme levels stayed just so flat and unflappable. It's a big change to how schemes were in the 1990s, isn't it?
Absolutely.
You mentioned surpluses there, and it's kind of the topic du jour at the moment. Do tell us a bit more about it and how they could potentially be spent by pension schemes. What are people debating?
Yeah, so schemes have the potential to build up material surplus over time. And I work with a lot of large schemes, so I see firsthand just how large these surpluses might become in pound amount terms. And while surpluses are certainly better news for trustees and companies than deficits, there are lots of issues for the trustees and company to think about. Without a plan for the surplus, the trustees could make strategic decisions that aren't fit for purpose or drift into a contentious situation with the company. So I think there's three key areas to think about up front. Who gets the value from a surplus? How will it be shared? And when is the right time to share the value? So on who gets the value, in the extremes, the company could take the view that it should be them. They've been on risk for deficits. They've potentially paid substantial deficit repair contributions. So they believe that they should benefit from the surplus that's been generated. On the other hand, the scheme is there to provide benefits to members. And to the extent that trustees have control of the surplus and have to act in members' best interests, the other extreme is that any surplus should go to members. In practice, we believe there should be something in it for both members and for the company. So the split between members and company is up for debate, and where it lands will depend on scheme context. But it is useful to iron this out up front, so both the trustees and company have clarity on how the surplus will be treated.
Yeah, and you can understand it from the finance director's perspective, can't you? I mean, they went through years of DB trauma with this volatile thing on the balance sheet, commanding more and more money. But you can also understand from the trustee's perspective that they might want to use that surplus to benefit members. And you're talking to large schemes. Many of those large schemes are running both DB and DC schemes at the same time, aren't they, Emma?
Yeah, absolutely. And I think from the company's perspective, if a DC scheme was part of the same trust, then the question is whether some of that DB surplus can be shared to the DC members within the trust. And with the advent of the pensions bill coming out and the potential changes to the way that surpluses are accessed and spent, there could be opportunities for employers to share that surplus with DC members out with the trust, if that becomes allowed. And I think from a company's perspective, that's kind of mitigating some of the inequity between DB members with generous benefits and their active employee population with DC benefits that are maybe not so generous.
Yeah. That whole surplus question just opens up all kinds of possibilities, doesn't it? And we do like to talk about investment on the Professional Investment Podcast. So talk to us about those options that maybe surplus is opening up in terms of investment possibilities. We talked at the beginning about how a very constrained and risk-focused investment strategy has led schemes to be able to weather the volatility of recent markets. But maybe we can get away from that a bit more, and maybe there is an opportunity for schemes to actually start adding returns now they're in this much better funding position.
Yeah, so I think we can think of investment strategy in sort of three buckets, if you like. So there's the assets that are there to back the liabilities. So that's the assets on the fully funded liabilities on a low risk basis. And those assets you would typically expect to still be invested in low risk assets, such as your LDI with high levels of hedging and maybe some high quality corporate bonds or credit in there. So that's the assets that if you were going down like an insurer route, that would be your kind of insurer assets. We would then build on top of that what we'd call a risk buffer. So a risk buffer, which provides a buffer against adverse experience. So you've got the value of your liabilities that you need, and then you build a buffer on top of that to ensure that adverse experience, you don't start sort of causing a deficit again. And then on top of that risk buffer, if there's more assets on top of that, you could think of this as what we might call the productive surplus. So those are assets above those required to pay benefits, pay those promises to members. And it's these assets that you can start to think about investing differently. So not within LDI, not necessarily within high quality corporate bonds, but start to invest that in higher risk, higher return assets. So that might be equities, might be infrastructure, timberland, might be some real estate private debt or private lending. So the higher end of the spectrum, risk and return assets.
So when you're talking to all these trustees, that ability to invest in that third bucket, the kind of like the real growth asset, is that potential returns that you can make from that, is that starting to motivate people to think about how they spend their surplus and maybe push them away from buyout and towards run-on? Is that having a change in people's attitude to the pension scheme?
I think it's certainly opened up the discussion within trustees. So we're schemes that maybe did have the objective to buy in X number of years are maybe revisiting that objective and to ask, is buying the right objective for us? And also therefore having conversations with the company, because back to what we said at the start, the company might see an interest in the surplus if they're going to be able to access that and extract surplus from the scheme. So I think it really is a review of objectives as to what trustees and companies are trying to achieve within within the pension scheme. Some will very much be like, the duty is to secure members' benefits, that's all we need to do. Others will start to think it's about doing the best interest of members, and therefore if we can enhance member benefits by growing a surplus, then we need to think about that. Lots of things to think about through that and the implications of it, but they are the sort of conversations that we're beginning to have with well-funded clients in terms of, if they do generate a surplus, what do we do with that? A lot of it will be scheme dependent, or a lot of it's scheme dependent on what they're allowed to do in the rules, but certainly we're having discussions around things for them to start thinking about. Part of that is also kind of the time horizon around it and how quickly you might grow your surplus. That might be, sort of lead into what you would invest in, because the quicker you grow it, the quicker you might start to distribute it to members. Or some people might do it not, lower risk for longer, build the surplus up slower, but then it becomes the intergenerational balance between benefiting members now versus benefiting members in the future. And generally these schemes have declining member populations, so you'd potentially have a bigger pot of assets to distribute among fewer members, and then the fairness of that. So lots of sort of things, challenges for trustees start to think about as we move into surplus space.
And is there a sense as well as, I can use this pot of money to make some more money, and that might be, interesting for us from a company and a trustee perspective? Is there also a sense that it gives you more freedom and more control over what happens to those assets? Because I'm wondering how much sort of sustainability is also growing that. Is it, we mentioned timber in the beginning and maybe nature capital, because if you go to buyout, you are handing over that asset to the insurance company and you're trusting that they are going to maintain what they say they're going to do over all the decades it takes to actually pay out all those liabilities to all of your members. So is that kind of ability to shape your investment values and your strategy and maybe implement a sustainable investment brief, is that also shaping how trustees think about these surpluses as well?
Yeah, I think so. All schemes will be different and all trustees' beliefs will be different, but there's certainly where trustee have strong beliefs for sustainable investment and for sort of the productive finance, investing in the economy to do better. That's certainly opened up the dialogue around if we have the opportunity to help, should we be using that opportunity? And that's about not just securing members' benefits today, but also making a better future for future generations. So I think that conversation is becoming part of the dialogue too, around sort of doing good for everybody, not just current pensioners. So absolutely. And I think having surplus assets definitely provides greater opportunity to trustees to invest sustainably or more productively. And ultimately, the decision will lie with the trustees with potential input from the company if the company have access to that surplus. So a lot of the constituents we talked about earlier will come into that. I think that said, though, there is certainly a growing momentum for DB pension schemes to be part of investing in and growing the UK economy. Money is tight with the government. Companies are feeling the pain with the national insurance increases. Individuals not particularly feeling flush given wages have struggled to keep up with inflation. Yet we do have this growing pot of money within DB pensions. So the mood from the government is for schemes to grow surpluses and invest in the economy. There seems to be a shift in tone from the regulator as well. So perceived wisdom was that the regulator preferred using schemes to use insurance, but the mood seems to be more ensuring trustees consider what's right for members. I think opening up that discussion around running on for longer, growing that surplus and investing that surplus for growth. Ultimately, as we said, the trustees' duty is to secure member benefits, but once these are secure and that risk buffer is built in, and it's invested, to high levels of certainty with high levels of hedging, then they do have the ability and opportunity to invest to grow that surplus and help the economy for future generations. So I think we're coming to a point where there's a clear alignment of interest for pensions to be part of sort of doing good for the future. And there's a part for pension schemes to play in that.
Yeah, and as you mentioned there, the government is becoming much more hands-on in pensions policy. You talked about productive finance. The emphasis was very much on sort of DC and maybe a bit of the LGPS, and now this emphasis is shifting towards legacy DB schemes, which obviously have the biggest pot of cash to play with, but there is this regulatory friction that we need to sort of get round. If you were to, that's not the only way the government is actually involving itself in pensions policy. There's an awful lot going on. And every time I do this podcast, I send everybody about 5 or 6 different stories to choose between, because there's just so much going on in the world of pensions at the moment. Do you see areas for policy improvement? We've had some indications where the government wants to go. Where do you see things moving to next? And where would you like to see things moving to next?
Yeah, so I think we are reaching a crossroads in the pensions industry. So all forms of pensions and lifetime savings are kind of meeting at this crossroad. And there's a once in a generation opportunity for us all to come together, learn from the past and really benefit the future. I think the government is committed to change. We've been encouraged by how quickly the pensions and retirement review came about and the new pensions bills have moved ahead. The second phase presents opportunity to make lasting changes as well and to really give people sort of financial independence through later life and for as long as they live. You mentioned there we've got private sectors have the opportunity to run on. We've got the existing to support existing members whilst also helping DC. LGBS have a part to play, as you mentioned. They've got scale and they can benefit fund members as well as local areas and UK growth. And then again, within DC, a lot could be done within DC to really support members. So benefits of scale that can come through CDC and broadening that opportunity set. So giving individuals a better outcome in retirement. So I think the industry does need a bit of creativity and innovation to help with this. Hymans did a paper recently named The Untapped Potential of Pensions, and it considered a package of proposals that we believe will deliver better outcome for UK savers. So I think some of the things we outlined in the package in terms of sort of ideas or improvements, as you put it, Charlotte, are around some ideas for how we could save money, and then also proposals on how you might invest that money. So we know cost is a barrier to increasing pension contributions, both from contributors themselves, be that workers and employers, and then also from the Treasury in terms of how they increase tax relief. So 4 areas that paper touches on are things like tax changes on pensions, so looking at when pensions are taxed, and if you're to change when they're taxed from being tax relief up front to be more a tax in income plus a contribution up front, the savings that could provide. The collective pension savings, so CDC schemes, pooling risks between groups of members to give higher expected pensions for individuals from that group for the same contribution, so savings there. Using pension surplus for UK investment, as we've talked about, UK DB schemes hold, we estimate, £160 billion of surplus capital. So like looking for ways to invest this in growth-oriented strategies could really generate substantial further surplus for investment. And then considering this is a sustainable state pension. So in its current form, the state pension is generous compared to other countries and potentially unsustainable. So looking at ways we could change that to save for the government, sorry. And then on how to invest, we looked at areas such as productive finance and growth assets. So we've talked about, I think we would need clear plans from the government and what those attractive opportunities are to really get investors excited and wanting to do it. Other ways to invest around enhancing an auto-enrolment. So is there ways we can increase the auto-enrolment kind of basic contribution rates to make that a better saving mechanism for more? And also the paper also considers self-employed workers and pensions. So only 18% of self-employed save for retirement compared to nearly 90% of employed workers. So any plans fixing retirement adequacy, you really need to start including self-employed people too, because that's just a kind of gap in the market.
Yes, well, I've got skin in the game as that one. I am self-employed, and the statistics are really, really stark there. You've just got this complete reversal where people who are employed have seen, their contribution levels to pension schemes go like that, while self-employed people have gone like that. It's really stark, and we're not an insubstantial part of the population. We are 1 in 7 workers, 15% of the working population. So it's a big issue, and nobody's really doing anything about that at the moment. There's been lots of chat about it, about how you go about it. And Steve Webb has made some interesting proposals around it, but I, as a self-employed person, I would welcome some movement on that. It would be good. I think what you mentioned there as well, and I think pulling it back to that sort of surplus conversation and that very strong funding position is this whole sort of debate about contribution levels, which I think is beginning to interest the industry more and more. Because we've had quite a lot of work and a few surveys recently that, like something like 50% of people feel like that they won't have enough at retirement. And we know that 8% is not enough to provide you with an adequate retirement. We could use surpluses to help that out in the situation where you've got a DB surplus and a DC scheme. But obviously that's a very ad hoc process where it's going to be a bit of a lottery of if you happen to be employed by a company that has that scheme that's in surplus, you could benefit. But it's not an issue that anybody seems to be grasping with any alacrity anytime soon. It is an issue that needs to be resolved.
Yeah, absolutely. And I think that, I suppose, it needs funded from somewhere. So looking at some of the other ways I mentioned earlier to try and make some of those savings to help direct some of that towards things like auto-enrolment to help with that fairness, so we're not building up a bigger problem in the future, which we know at the moment current contribution rates will not provide adequate sort of retirement savings for the people just paying basic amounts.
So if we turn once back to investment, do you think this third pot, does that open up greater investment diversity within the world of DB? Because let's be frank, it's become quite boring recently. I would argue possibly even more boring than the world of insurance. Sorry, insurers. But we have this very heavy emphasis on LDI and gilts, and then we have this very heavy emphasis on global credit, which is used in a similar way to an insurance company to provide the cash to pay the benefits. And post LDI crisis, there's been no further investment in private assets because everything else got sold, and you got this wonky portfolio with too much actually allocated to private assets. Are we seeing things like settle down, and with the surplus, is that opening up greater investment diversity in these portfolios?
Yeah, I think so. And I think we have to sort of change the mindset of trustees, where we've been on a de-risking journey for a long time and we've come out of a lot of these assets. And that's been the right thing to do. It's not that we've done the wrong thing, but we now come to a point where assets are going back up. And the assets that we've got securing members' benefits are much safer. They're much more hedged. They're much more de-risked. With much more certainty around that. So these additional surplus assets, there is the ability and opportunity to do something a bit more exciting with them and not just invest in LDI and sort of credit, which is what a lot of the schemes now see. I think there also has to be a shift in the mindset of if we invest surplus assets in more return and income generating type riskier assets, then as funding levels improve, as surpluses grow, the proportion invested in these risky assets will grow as a proportion of the overall scheme. And therefore, this idea of re-risking has got to be something that trustees and companies become comfortable with going forward after their long de-risking journeys, that it will be a period of re-risking. But you're not re-risking and taking away the certainty that you've already built up. You're re-risking on these kind of additional surplus assets. And I think how you invest them will potentially depend on how you are going to use or distribute that surplus. So if you need flexibility in that surplus where you want to pay it out regularly, you might invest in the more liquid sides of those risky assets. Whereas if you're trying to grow it over a longer term with a longer time horizon in place, then that opens up the more illiquid assets like private lending and real estate debt, etc. So I think that's where you'll start to see a mix in what those surplus assets might look like, depending on each individual scheme's objectives for surplus and surplus distribution.
And their time horizon as well. Because that's the biggest determinant of how much risk you can take is time horizon, after all, isn't it, when it comes to the world of investment? Sometimes I think we forget that. You know, that's why we invest in equities when we're 30 for our retirement in 25, 30 years' time. We've got time to go through the market shocks and to recover. Are you, I mean, I know this is a bit of a weird question because you are advising trustees, but are there particular asset classes that you are seeing that you are interested or trustees are interested, either on that kind of less risky bucket or that more risky bucket?
So I think in my schemes at the moment, we're not at the stage of investing the surplus. I think we're more at that planning stage first. So going through the process of understanding how we're going to share it, who's going to get what, how we're going to distribute it, because we really want to underline what those objectives are to help set the investment strategy for the assets. But I think, yeah, traditional equities would be in there, as we said, infrastructure, maybe timberland, maybe some natural capital. So they are the type of sort of growth assets that we would have invested in the past and we've de-risked out of will I think, come to the fore again in terms of growing assets, because it's almost like we're back to the time where we were trying to grow assets. We're trying to grow assets, but it's just a smaller slug of additional assets that we are trying to grow. And the objectives will be different because we don't have the same liabilities to hedge that we had in the past, because they're already kind of hedged out with your liability matching assets. So I think it looks slightly different, but it'll be similar types of assets.
I mean, it reminds me slightly, and I'm not completely au fait with how insurance companies run their business, but it's kind of a similar model, isn't it? And that you kind of like have a sort of cost of capital that applies to sort of parcel everything off, and you make sure all your liabilities are sort of neatly hedged, and then you have that bit of surplus capital on top that you can invest. So it's quite a similar model to an insurance company. Is that correct, or am I completely wrong there?
No, I think you're right. I think it's almost like, if you buy out you're fully buying your liabilities, you're passing them off to insurer. And with run on, what you're doing is almost just emulating what an insurer would do, which is investing like an insurer for those asset liability matching assets, building in your contingency, your risk buffer, which will still be invested in something pretty stable, and then being a bit more high risk, high return in those additional assets. So yeah, not unlike what insurers would do.
I know you said that this third bucket is relatively small, but it's still sort of like 160 billion quid. So it's not that small.
And growing. Yeah, small and growing. Small relative, typically at the moment, small relative to an individual scheme's overall, depending on how well funded they are. But yes, set to grow. We did it recently on one of our clients, and the speed of growth of the surplus by not investing in anything that not generating too high a return is quite remarkable, because you're not paying out liabilities on it. It's pure investment growth.
It's a pot of money that's designed entirely for that purpose and that purpose alone, of investment growth.
Yeah.
Okay, well, I think that is a great place for us to end this podcast. Once again, we've managed to cover an awful lot of material in just under half an hour. So I want to say thank you, Emma, for all of your insights and expertise. You've been an excellent podcast guest. Listeners, if you want to make sure you never miss a future episode of the podcast, do hit the subscribe button and make sure that you interact and comment on the podcast. Thank you for listening.